Indianapolis inventory just hit a 10-year high. 22% of listings are now slashing prices. The average home is sitting for 48 days. That's more than double what it was in 2023. But here's what nobody is telling you: that affordable price tag you keep hearing about. It's not a deal. It's a liquidity trap. And if you buy wrong right now, your equity could be gone before you even need to sell. Here's exactly what's happening in Indianapolis and why the smartest investors are already repositioning. Investors are flooding into Indianapolis right now. They see median prices under $250,000. They see rent-to-price ratios that look amazing on a spreadsheet. They think they've found the last affordable market in America. But price is only half the equation. The other half is whether you can actually sell when you need to. And right now, you can't. 2,810 active listings. That's the highest inventory Indianapolis has seen in a decade. And it's not seasonal. This has been climbing every single quarter for 2 years straight. More listings, fewer buyers, same story every month. The result? Sellers are panicking. 22% of active listings now have a price cut, not 1 or 2% off. We're talking 5, 10, $15,000 reductions, and the homes still aren't moving. Days on market tell the real story here. In 2023, the average Indianapolis home sold in 22 days. Today, it's 48 days. That's not a cooling market. That's a freezing one. But here's where it gets dangerous. This isn't just a housing story anymore. It's a contagion story. Indiana's auto loan delinquency rate is 4.8%. That's 55% higher than the national average. Here's why that matters for housing. When people stop paying their car loans, their mortgage is usually next. Auto defaults are the canary in the coal mine. And that canary stopped singing 3 months ago. We saw this exact pattern in 2008. Auto delinquencies spiked first. Housing followed 6 to 9 months later. The timeline is almost identical. But there's one chart that exposes the entire illusion. Look at zip code 46204, downtown Indianapolis. Prices down 18% year over year. Rents? Flat. Think about what that means. The asset is losing value, but the income it produces isn't growing either. That's the definition of a liquidity trap. You're buying an asset that's depreciating, with no income growth to offset the loss. And when you try to exit, there are 2,800 other sellers standing between you and a buyer. Now here's the pivot. Because every liquidity trap creates a specific type of opportunity. The investors who win in this environment, they're not chasing the median. They're not buying turnkey rentals at market price. They're buying distress. They're targeting the sellers who've already cut their price 3 times, the ones sitting at 60+ days on market, the ones who are now motivated, not just listed. That's the difference. A listed seller will negotiate. A motivated seller will deal. And in Indianapolis right now, the gap between list price and sold price is widening every month. That spread, that's your margin. But here's the catch. And this is critical. Not every zip code in Indianapolis works this way. There are pockets where demand is actually holding, where inventory is tight, where the contagion hasn't spread, and those pockets are not where the headlines are looking. I mapped them, all 7 of them. I'll break down each one, exact zip codes, price points, and the specific entry strategy for each in the next video. Subscribe now so you don't miss that breakdown, because the window on those pockets It's closing faster than anyone realizes,